Welcome to Cup of Bull. My name is Michael Dunham. I'm the Director of Planning here at Fontana Financial Planning. With me today is Patrick Fontana, founder of the firm. Thank you, Michael. Welcome. Patrick, today I want to talk about the topic of inheriting large sums of money. I'll say that it's common that if somebody's not working with a financial planner of any sort, this is kind of one of those life events where maybe they open their eyes and they realize that things are a little bit more complex than they were ready to handle on their own. And so a lot of times this may be a reason why somebody reaches out to us for some help and initial conversation about what's going on. Mm-hmm. So with that is kind of the headline of the situation. Wanted to talk through a couple of things that may be good for people going through that themselves to be aware of. So to kick it off, the first thought and the biggest thing I think a lot of times is the tax considerations. It's very rarely that somebody just gets $1 million in a bank account. Often there's different account types, and those different account types have different rules and different payout structures. So can you talk a little bit about tax considerations to start?
Sure. So there's a couple big things to know that in most cases at death, there's a step up in basis. So if you have $100,000 of one stock that grandpa had bought years ago for $1,000, in his lifetime, there was a big gain to be paid if he sold it. And that's one of the reasons maybe he kept it all these years. When you inherit that 100,000 of Exxon stock, it gets a step up so that the basis is 100, the value is 100 at the date of death. So that essentially does become tax-wise kind of like cash. There's not a bill due. But if it's a retirement account with a zero basis and there's income tax due on the entire account, which we had a real-life case like this pretty recently where there's $1 million of IRA money, income tax is owed on that. So deciding and understanding, what is the true kind of net number that's coming out here is very important. Annuities, similar consideration. If there's an annuity with a low basis, it's got some income taxes due. So the tax considerations are huge, and just understanding, what we're dealing with is a good starting point.
Yeah, one thing I'll add to that, a couple of years ago, they changed the rules. So it used to be for retirement accounts, you were able to stretch out the distributions that they make you take over the entirety of your lifetime. Mm-hmm. And so people in that situation, they had to take a little bit out, but it was a small amount that they had to take out every year. And a couple of years ago, they changed it where most beneficiaries have to take out the entire balance within 10 years. And so a mistake that unfortunately we too often see there is somebody who's maybe 3 or 4 years into that 10-year window, and they've taken no money out of the inherited IRA that they received. And now they've condensed that down into a much smaller, call it 5 or 6 year window, where if you've got $1 million, you could have taken, roughly $100,000 a year for 10 years. And now you may be forced to take $200,000 a year for the next 5 years, which can push you up into higher tax brackets and leave less to you and more to the IRAs.
Right. And I know we both have real life experience with this, and it's a timing situation. When this happens, it's advisable to get advice before you go and make major moves. My father-in-law passed before those tax law changes. And so my wife and her siblings inherited some IRA money that has essentially that stretch feature. So they don't have to take it all out in 10 years, where fast forward like a 1 or 2 year difference. When Michael's mother passed, the rule was already in effect. And so that 10-year rule is now a big deal. Another thing we didn't touch on is the difference of, owing income tax or potentially being tax-free. So I know if you have a Roth IRA that still has that 10-year limit, what's the smart thing to do?
To wait. So in that case, you don't want to proactively take any money out that you don't have to. Now, there's been a lot of unclarity around this, but starting this year, 2025, you will have to take small required distributions every year from any inherited account. But if you're in that situation, take the required amount that you have to, leave everything else that's in the inherited Roth IRA to grow tax-free as long as possible. The last thing I'll add to this too is if you are in a situation where you're working maybe with a parent who is still around, but you know that ultimately money is going to get left to you or you and siblings, just doing an analysis of what is your tax situation versus their tax situation. A lot of times what we find is retirees who have no income other than the income that they kind of control and force upon themselves. They're often in much lower tax brackets than their children, who are often in their highest earning years are. And so it may be advantageous for them to do what's called a Roth conversion, intentionally take some of the IRA money that they're never going to touch, flip it over to Roth, pay an income tax bill at a more attractive rate, knowing that it'll ultimately pass to you and your siblings and be able to grow tax-free and not be subject to those higher rates.
So ultimately, we're talking about inheriting large sums of money. And there's certainly advantage to getting a hold of this early. So when the parents are still around and can do some of these proactive moves and avoid taxes altogether, potentially on chunks of money that would have taxes, it's smart to do. So the next point I know we want to just touch on is thinking through, goals. Once we know what's the after-tax money and what are we really dealing with here, thinking through what's our advice in general when folks inherit a large sum of money. I've seen several cases where mistakes are made. And the biggest thing people do is spending money before they have it, essentially, with no plan. And it's totally true that many cases people are worse off financially after inheriting money when they do that kind of move. They go out and preemptively buy a new car and go to remodel their house. And next thing you know, they spent more money than they actually inherited. And then they're worse off. So it's a bit dangerous, and you got to decide. And I'd say general big picture advice is to move slowly. Anytime there's a big life change, having a child, buying a house, parent passes away, you inherit money, these different big things, to go slow, kind of give it a year before you make any major decisions like moving or any of those big life decisions. My advice is to take your time.
Mm-hmm. And I'd add to that, just if you are going to enjoy some, there's nothing wrong with that, but having a plan for what you're going to enjoy going into it, right? So instead of just kind of making an exception to the rule every time you decide you want to spend more money, say, hey, I'll take 10% of this and we're going to go on a nice trip. Maybe we're going to do some upgrades to the house, buy a new car, whatever it might be. But you've predetermined what you're going to enjoy right now so that you can be intentional and long-term with whatever is left over.
Absolutely. Good words.
Awesome.
What are we going to do with this money as we inherit and go forward?
Rebalance until rich.
Rebalance until rich.
Thanks for watching.